and a slightly unusual meeting between me and Paul Correa of Fiduciary Wealth Management tonight. Normally he and I have a chat, but he's got a special treat for us this evening in the shape of a tax-efficient investment opportunity for EU and UK expats in Portugal. And he'll be introducing James Clark to you right now. Good evening, Paul.
James has been in financial services since 2001 when he joined AXA. I met James, must have been 2013, 2014 when he was at AXA, and then subsequently when he moved on, I think in 2016, to Utmost Wealth. And James will explain everything about Utmost Wealth, and he now heads expatriate services for the whole of Europe. So with that very brief introduction, and he will explain everything about the Apex Portugal proposition and how it could be beneficial to expatriates in Portugal. So without further ado, James, I pass on the baton to you, yeah?
Thank you, Paul, and good evening, everybody, or good afternoon, wherever you are around the world. And thank you very much for the invitation to see so many of you. I'm going to share with you some slides, so just bear with me for a moment while I make sure I get into the right screen. Hopefully you can see the screen. If I'm moving it and it doesn't move, please shout at me, because I can't necessarily see the notes section and the chat section at this moment in time. But yeah, I'm here to introduce the Apex Portugal proposition. He says, okay, first and foremost, I'd just like to introduce who the Utmost Group are. It might be a name you're unfamiliar with, so I just wanted to spend a couple of moments on that. So the Utmost Group of companies has been around since 2013 and is owned by its founders, Paul Thompson and Ian Maidens, and backed by Oaktree Capital. Now, Oaktree Capital run funds and run over, as it says there, 150 billion of assets under management. So as a company we formed in 2013, and our business really is we are a specialist life assurance group working with investment advisors like Paul and his contemporaries in this marketplace. We don't do anything else. We just provide the appropriate wealth structuring and tax planning solutions for people in this market. As a business, we run over 37 billion pounds worth of assets, so we have that under administration, and we operate headquartered in the UK, but we operate internationally out of the Isle of Man, the Channel Islands, the Far East in Europe, where our headquarters there are in Ireland. We also have over 960 people that we employ, and just to give you a sort of a feel for where this company has grown from, it is the amalgamation of a number of businesses which have been acquired by the Utmost Group, including AXA, as Paul mentioned, where I came from, but they have also acquired companies like Generali Pan-Europe, Generali Worldwide, Aegon's international business, Aviva's international business, and there is a business called Quilter International, which will become part of the Utmost Group later this year. So as you know, it's a growing business and one which has been around in this time to try and take advantage of the market. So that's where we are. Just a bit about the Utmost Group and credit ratings. I know a lot of you will be interested in the financial strength of a business. We have a rating from Fitch, one of the three major ratings agencies, and they have rated the Utmost Group and our companies within it as an A, which is stable. I always think of financial strength and credit ratings a little bit like a crash helmet, really. You know, when you buy a crash helmet, you never actually want to use a crash helmet, but if you did, you would want to make sure that it's a very secure one and one that's going to save your life and make sure that you don't get hurt. And that's what these credit ratings do, really, to make sure that they rate companies like ours to make sure they're providing the right kind of support and financial strength for those people who are investing their assets with us. So that's a bit about the group. And as I say, I think we've got some questions at the end, if that's okay. But of course, if you have any others, put them in the chat box, and we'll do our best to work through them. I'll rely on Paul to mediate them. The Apex product, what is Apex product? So this product is really aimed at those clients who are looking to, are already tax resident in Portugal, or those who are looking to become tax resident in Portugal. And in very simple terms, it is a unit-linked life assurance policy, which is invested in funds following a strategy as selected by you. And that strategy will be discussed between you and your intermediary, which would be Paul. That's basically it in terms of the structure of what we provide. And there are reasons why unit-linked insurance can provide a number of benefits to underlying clients. So who is it for? Now, this product is really aimed at those clients who are looking for a medium to long-term investment. It's not really for those people who are, want to park some money for a couple of years before they buy another property. This is really for people who are thinking about their tax planning over the next 5 to 8 years. And in that, you can have a number of different investment strategies that work within it. And that's something that we can talk about a bit later on. Another point to bear in mind about the product is that it's a compliant solution. Now, I used to gloss over this point when I presented it in the past, but actually it's incredibly important, because a lot of advisors, not a lot of advisors, a lot of clients that come to advisors of mine will say to me that they've been offered a solution or they've been sold a product which may not be compliant in the Portuguese jurisdiction. And to be clear, this product here is aimed at those people who are tax resident in Portugal now. Now, if people are looking to move to Portugal, then this is something to consider for when they get there. But the reason why it's compliant is in the actual makeup of the product. And what that means is that there is a parafiscal charge that we pay to the Portuguese tax authorities on behalf of the client. And that's what lodges its compliance with the tax authorities in Portugal. So they know exactly what we're doing. They're fully aware of our solution, and we provide that level of reporting to them. The reason why would somebody want to do this is probably tax efficiency, and a unit-linked life assurance product can benefit from favourable tax treatment in Portugal. And I'll explain a bit more about how that works in a while. There are also a wide range of investment options. We're aware that not one size fits all, and our job really is to make sure that we provide a number of different investment options available to clients when they come to take out this policy. And I'll explain what those options are. Another point is around succession planning. A lot of people have worked very hard and maybe sold businesses and been successful in their careers and lives, and whether they're out there in Portugal for work and lifestyle reasons, or they're there to retire. One thing that is important that I find when speaking to clients is that they want to make sure that their benefits are left to the right people, and want to make sure that they're looked after correctly. And we do that through the nomination of beneficiaries on the policy. Now, the right policy in Portugal will have to have the relevant beneficiary clauses attached to them. And again, that's something which draws back to this compliance angle. And finally, as a business, we have a wealth of experience. I've demonstrated, of course, that the business has grown through different acquisitions with different companies and being part of it. But we've got a long track record of working in lots of different markets and different countries as well. So we have solutions in Spain, Italy, soon to be France, as well as the UK and further afield. So where clients decide to then move to a different country, that's where we would work with the intermediary to help them in that scenario. Okay. So looking at tax efficiency, why do life assurance policies work well in Portugal? Well, the way the tax works in Portugal is that if you hold an asset, when you sell it, you pay capital gains tax on it at 28%, which is this figure here. This figure here, 28%. If you hold the assets within a policy of life assurance into one of these tax wrappers, you effectively, by holding it between 5 years and 8 years, get a reduction of 20% of the tax payable on the gain. Or if you hold it for 8 years or more, you get a 60% reduction in the gain. So the point being that if you hold an asset for 8 years or more, your effective rate of tax is only 11.2% instead of 28% if you just held the money in a general investment account. As it says there, you need to have paid 35% of the premiums in the first half of the contract, which is why we talk about this being a medium to long-term investment. So this prevents people, say, putting in, I don't know, 100,000 in year one, and then trying to top the policy up in year 7 with €1 million or something, and then trying to take advantage of the 11.2%. So it's important to know that you have to pay 35% of the premiums in the first half of the contract. Also, life insurance premiums are excluded from Portuguese stamp duty and VAT, and there's no VAT payable applied to portfolio management of fees that are based in Ireland. So if you decide to appoint a discretionary manager to your policy, there's no VAT payable in Ireland, and that's something specific to Ireland, which I'll come back to. Finally, death benefits are out of scope for Portuguese stamp duty, and for those of you who know, that's the equivalent of inheritance tax in Portugal. Okay, moving on to the investment choice. Whilst I understand everyone has different levels of knowledge around investment options and their preferences, we offer 3 simple routes to market really for clients. The first option is to go via an open architecture structure whereby you can buy funds through our Citibank custody that we hold within the product. And that's typically unit trusts and OICs and things of that nature, which you may have used before. The second one is to use a platform, and I know that that's something that Fiduciary have used before. And what I say, where a platform works well is if you have perhaps a pension with another company and you want to take out one of these products with us, you can sometimes have the same investment strategy across the piece using the platform. That allows that consistency, which a lot of clients like. The other option, of course, is to appoint a discretionary fund manager directly, typically for the larger premiums. And that's where you will sit down with a discretionary manager in conjunction with the intermediary to decide how you want to invest your assets. And all 3 of these options are available through the product. And it's really down to the intermediary to assess that with you to work out what's best. I mentioned succession planning and why life insurance policies work well. The 2 key points really is around the beneficiary clauses. And what this allows people to do is to make appointments around the clauses that are in there to make sure that it meets their succession planning needs. So in very simple terms, you have 2 types of beneficiaries, a revocable and an irrevocable beneficiary. Revocable meaning that you can change it. So that's quite helpful if you have, for example, children that may have children of their own and you may want to leave it to unborn grandchildren. So that would work well there. Or irrevocable beneficiaries are where you can't change them, of course. That provides you with less flexibility, but for different planning reasons, that might be something you want to consider. Payments to beneficiaries, as I've said, are outside of scope for stamp duty, which is good news. But crucially, and I think a number of you may be from the UK originally or may consider returning to the UK, is that this product has been built with that in mind. And if a client comes back to the UK, you can revoke a revocable beneficiary nomination without requiring an endorsement. So that's quite good. And the other point is that the proposition has what they call segmentation. And I don't want to go into too much technical details around this, but in very simple terms, all a segmentation means is that whilst it means nothing in Portugal, if you move back to the UK, the policy is split into mini policies, meaning that you can select how you would like to change the policy in the future. You could, for example, want to do some inheritance tax planning, or you might want to assign some benefits to a different person. So the reason we segment a policy in Portugal is with that in mind, that if people do go back to the UK, it still provides them with all the options that they would have had they have taken this policy out whilst a UK tax resident. Okay,
James, a quick question. Can you in specie assets into the Apex product? Can you transfer assets in, whether it's funds or other securities from a different provider into the policy to start the policy up, or has it got to be cash?
So we will happily accept cash, of course, but yes, to answer your question, you can in specie assets into the policy. Some things to look out for there. Number one, they have to be permissible, and that means we would have to check through we have investment parameters for all of our products, and we would have to make sure that those investment parameters were met and they were permissible, and we can check that. So if you're a client and you have a statement with a list of funds on it, we can check whether they are permissible into the product. The second point being that they have to be funds. We can accept funds through the open architecture piece. If it was stocks and shares, you would probably need to appoint a discretionary manager and speak to them about working with you to manage that asset as well. So we do have layers of sort of restrictions, because the idea being that the more sophisticated investments, direct shares and direct stocks, would be held through a DFM, discretionary fund manager. Whereas if it's just simple unit trusts and OICs, you would buy them either directly through us or through a platform. And again, that's something we look at on a case-by-case basis. But to answer your question, yes, we can. The only point being that you can't in specie cash, you'd have to pay that in separately.
Fine. James, can I go back one or two slides talking about chargeable gains? And you said the effective rate of tax on withdrawals after you've kept the policy for 8 years or over is 11.2%. Yeah. Is that 11.2% on the capital growth element of any withdrawal, or is it on the full amount withdrawn from the policy?
No, it's on the capital growth. So in Portugal, you effectively get your money back. So therefore, let's say you were to withdraw 60,000, but the equivalent of that is grown by 20,000. It's the 20,000 there that would be applicable to the tax rate, because your 40,000 is deemed return of capital.
Okay, perfect.
Yeah,
makes a lot of sense. Yeah, thank you.
No problem. Okay, so we good to move on?
Yeah.
Okay. So just going to skip through the product really, and again, this is just for information only, I should point out. The life assurance product has a death benefit of 100% of the investment value. You can hold up to 6 lives assured. This is important, of course, because you may have people who you want to make sure that are kept on the policy. The age limit is between 18 and 80, which I think probably covers 99% of people who are on this call. You can do it on a single or multiple lives basis. So husband and wife, for example, you would probably do it on a multiple lives last death, so that in the event of a client being deceased, the policy can continue. Of course, when the last survivor dies, then the policy will be encashed. So it's about the control that you exercise at that point. The death benefit is then paid out to the beneficiaries, as we spoke about earlier with the clauses that are there. I mentioned about moving back to the UK. This is a key point really around the product. One point that's worth raising is the fact that we have this ability to add life cover from inception to activate it on return to the UK. So that means that the policy becomes compliant back in the UK should a client return without requiring any endorsement. So obviously we've got a strong tax team in the Isle of Man who are familiar with the UK tax law, and they've had a role in building that bridge really for when clients do decide to come back. I mentioned the revocable beneficiary nominations being removed, so that's something to point out. And the other thing to be aware of is that the investment options must comply with UK tax laws. Now, I would imagine it'd be incredibly rare for somebody to hold a policy in Portugal which would not comply with UK tax laws, because the permissibility criteria is quite similar, and they don't allow things like private company shares, and they don't want the product to become personalised, because that goes against the spirit of what a life assurance product really is.
Effectively, James, there's tax consequences for allowing non-permissible assets, which would make it a permissible bond in the UK, right?
That's right. Yes.
Yeah.
Because that way you suffer that issue really of paying the tax if that was the case, and it's important
Exactly.
that we check that, and that's something we check. So if the client was moving back, we'd expect to carry out some administration there by checking out whether the assets would be suitable in the UK.
James, very quick question again. What happens if someone's circumstances change and they return to the UK or wherever it is, wherever they move to within or before the 8 years are up? What's the tax consequences of that, and how does it all work?
Right, that's a good question. Probably a bit of an open question in the sense that it kind of depends where they go to. So if you're moving from one EU jurisdiction to another, most EU jurisdictions will recognise the fact that you've held a policy in Portugal, for example. However, it depends where you move to. So it's difficult for me to answer really that part of the question. Of course, if you move back to the UK, one thing I can say with certainty is that you qualify for something called time apportionment relief, which means that they take into account the number of days that you have been out of the country. So let's say you took out a policy in year 1, and in year 5, for example, you moved back to the UK, and in year 10, you decided to surrender the policy. What they'll do, you're obviously subject to UK tax at that point because you're UK tax resident, but they will look at the number of days and work out how long you've actually held that policy inside the UK and apply a reducer in terms of the tax because you've been out of the country for half of the period that you've held the policy. That's how that works, and it's really there to help those clients who have been outside of the UK in terms of their tax. Does that help?
Yeah, it does. Thank you.
Okay. Good. Okay, moving on. I wanted to mention about Ireland and as a jurisdiction, why the Irish advantage of financial services and why we do our product in Ireland rather than any of the other options available to us. So, of course, Ireland is an EU jurisdiction, and one of the things that you will find if you're investing in Portugal is that there are really two major players in terms of countries where you can buy products from. That's Ireland and Luxembourg, both of which are perfectly compliant and legitimate in what they're doing. One thing I just wanted to raise here was around the differences between the two so that people have a better understanding, and as well also provide some detail around the similarities that you hold in these situations. So the solvency regime that governs both Ireland and Luxembourg as jurisdictions for writing business is the EU Solvency II, and that is around the sort of, as it says there, the improved consumer protection and modernised supervision that sits behind that. These are EU directives and regulations which sit across what we do really, and why us as a life company have to make sure we maintain those. Another important point, and this goes back to the policyholder protection piece, is around segregation of policyholder assets. So when a client invests money into Utmost, their assets are completely segregated from the company assets. And that's by law, both in Ireland and in Luxembourg. So the assets held are separate to those of the company. So that's really important to make sure you have that protection. The point there around governance of custodians, what does that mean? In Ireland, we have a Central Bank of Ireland requirement that they verify and make sure that the custodians we work with are the right ones. So I mentioned, for example, we use Citibank as our custodian, but of course, if you appoint a discretionary manager or you use a platform, then the custodian is different, but they have to meet those standards. In Luxembourg, they run what they call a tripartite agreement, whereby the custodian will always be a Luxembourg-based bank rather than a discretionary manager holding the money on their own nominee. So all that means is that it brings in a third party really to the provider intermediary relationship, which it doesn't materially affect things. It's just the way in which they do it. In Luxembourg, they insist on you using one of their banks, whereas in Ireland, the Central Bank of Ireland verify all these custodians anyway. The governing law is slightly different. In Ireland, you've got common law, which of course is developed from case law. And in Luxembourg, they operate a civil law, which is of course in statute. And that's obviously underpinned by the EU because they're both EU member states. So if you did want to read about civil law in Luxembourg, your French needs to be quite good. But outside of that, they're both offering that EU underpin on both jurisdictions. I mentioned about VAT on discretionary fund manager fees. Now, this is an important point really when distinguishing between the two jurisdictions. With Luxembourg, you pay 17% VAT, like you would do if you were holding the policy in somewhere like the Isle of Man, if it was somewhere like there. But in Ireland, they took a decision to enshrine it in the law that they didn't want discretionary fund managers to be treated any differently to open-ended investment companies, OICs. So they basically created a situation where there was no VAT on the fees, meaning that that's now wrapped in the legislation and is not going to change. So if you're investing by a discretionary manager, there is a tax saving to be had by going through Ireland. And finally, just to, again, this is just to put your mind at rest, really. Has a failure of a life company ever occurred resulting in a loss to a policyholder in Ireland? No. And I think they're absolutely conscious of that, even back to when we had the banking crisis in 2008. But in Luxembourg, there was an example of that with XL Life going in 2013. The point being, though, that you're investing in a company in Utmost, which are providing a structure for you to then go and invest in funds and assets to your heart's content, really. Finally, a couple of other advantages of the product before I open up to more questions, and I'm sure that will probably become the main debate. These products are relatively simple and efficient in terms of what they do. They're quite a simple and efficient way of setting up a policy. You invest the money into one of our tax wrappers and we take care of it that way. You can also add premiums at a later date. We have a number of situations where clients want to start by doing one of these things, and as you know, there is still tax advantages to be had even if you top the policy up over the course of the years that go along. So that's something that's good. Certainly if clients are selling down investments or they're trying to sell a property in a different jurisdiction, that can be good. You can also use the policy, as it says there, to pledge to obtain liquidity. So if you were doing some borrowing, that's a slightly unusual situation. We don't see it very often, but that is something that is available via this product.
So James, you can assign the policy to a bank as security for a mortgage, right?
That's right, yes.
That's basically it, yeah.
That's basically it, yeah. And finally, just the point on simplification of tax reporting. Once this is lodged with the Portuguese tax authorities through us, you don't have to report it each year until such time you actually make a withdrawal, and then you have to pay tax on the gain. So it can just roll along in the background and work quite nicely for a lot of clients. So that's really it in terms of my slides and my presentation. I appreciate there may be quite a number of questions, and really that's where I'll open up the floor, Paul, for you to
yeah, perfect. I'll just have 3 questions and then I'll pass it on to Carl and to the floor. How are UK ISAs treated in Portugal? And with the second question, how do they work and can I take income from them?
Okay, so let me come out of the screen share and so I can see you all. Okay, the first question then was around how do UK ISAs work? So the important thing to remember is UK ISAs are tax-free in the UK. They are not necessarily tax-free in other jurisdictions, and that's something to bear in mind, particularly if you have applied for or are on the non-habitual residence regime. Because as you know, if you're an NHR client, you'll either be paying 0 or 10% tax on your income, but that income is based on foreign sourced taxed income, whereby an UK ISA, of course, hasn't been taxed in the UK because it's tax-free, meaning that you're probably advised really, and I'm not here to give advice, Paul, as I should reiterate, is just to probably do something with them prior to moving to Portugal.
Yeah, good. Thank you for that, James. I've got just 2 quick ones. which countries are blacklisted by Portugal, and what are the implications tax-wise of being blacklisted?
Yeah, so this is a good question. This comes around from the fact that the Portuguese tax authorities have some quite stringent restrictions on which countries are considered tax havens. And if you ever want to know what that list is at any given time, just type blacklisted tax havens into Google and click on the PwC page, because that's always updated on a pretty regular basis. Other consultancy agencies are available, but that's the one that I tend to go to. So what that means is that if you hold a policy from somewhere like the Channel Islands or the Isle of Man even, which is where we hold policies, those are considered tax havens in Portugal, meaning that the tax on the product would be 35% rather than 28%, which is what you pay as a standard in Portugal. So it's a good time to review those policies if you have them prior to moving to Portugal, if possible.
Good. And how does Apex work in conjunction with NHR? How does that work efficiently?
Yeah, so the way I'd probably look at this is it runs alongside it. It isn't something that you invest in and it gives you NHR. It's not like that at all. The way the product works is for, if you think about the NHR and the benefits of doing it, is that you can take income tax efficiently from foreign sourced vehicles. But if you've got other assets, whether they be investments or whether you've sold a property or sold a business and you've got other cash, it's that kind of vehicle that runs alongside your NHR application. So as we talked about the tax, after the end of the 8th year, you only pay 11.2% tax on the gain. So that is similar to what the tax is on an NHR anyway, because it's 10%. So the idea being that this runs alongside it, and I think of them as like your sort of like T-earns. You take your income in the first 8 years, 10 years from your pensions and your NHR application. And then when that pot has run out, you then take the income from the Apex policy, because that's the one that's providing you with that extra income. And you have had it in for 8 years, so therefore you're paying less tax. And I'd use the two together as a financial planning vehicle. And Paul, one thing I would say is if you think that you're going to need the money in the first 5 years, I probably wouldn't do it, because the benefits probably aren't offset by leaving it where it is, and using other things around that. So it's about using a combination of different structures to achieve it. We only provide one, and that's what I'm here to talk about. But that's the job for you, really, I suppose.
No, that's brilliant. Thank you, James. Carl, I'll pass the baton on. Yeah.
Thank you very much, James. Thanks very much, James Clark there, and Paul. Thank you, Paul Correa. And I'm going to stop the recording, but suffice to say that if you want to ask any more questions, if you're interested in the product, do speak to Paul, and you can find Paul Correa at Fiduciary Wealth Management in our business directory. Okay, so we have some questions. Thank you, Colin, Doug, and Kevin. We'll come to you now after I've just pressed this button.